I have a very salient fear and belief that relief that usually comes from lower interest rates. I mean, the Fed controls the short end of the yield curve. There's no doubt about that. So they can always take interest rates to zero. T-bills will go to zero. Fed funds rate will go to zero. But the long end of the bond market, which is concerned about supply and inflation, might not respond. The value of a currency is the faith in a fiat currency is what inflation is all about. And people lost their faith in the U.S. dollar's purchasing power, not against the euro, not against the yen or the pound or the yen. They lost faith in purchasing power against hard assets, against, edifices. So there's no quick salve if that's the case. So that's my caveat. And I'm watching it carefully.
Welcome to today's show. We begin with alarming news from the U.S. commercial real estate sector, where a staggering $1.5 trillion wall of debt is on the horizon. Analysts warn that this looming debt could exacerbate the risk of defaults. Commercial properties potentially might be plummeting by as much as 40%, continuation in the housing problem as home prices soar to all-time highs. Meanwhile, in central banking news, the U.S. Federal Reserve's balance sheet has surged by almost $100 billion this week alone, now totaling a remarkable $400 billion. This expansion reflects the Fed's ongoing efforts to support cash-strapped banks, particularly following the collapse of Silvergate, Silicon Valley Bank, and Signature Bank. Adding to the strain on the banking sector, projections suggest that U.S. banks could face another $160 billion in losses as the commercial real estate market braces for its most significant crash since 2008. With the sector on shaky ground, the potential impact on banks underscores the challenges ahead for financial stability. Stay tuned for further updates as these developments continue to unfold, shaping the economic landscape in the United States and beyond. Now, in the continuation of the episode, we'll show you more clips of Michael Pento. But first, hit the like button, smash the subscribe button, and turn on notifications. Let's get into the video.
I incorrectly called for a recession in 2023 because I understood the fact that these banks were going to be under a lot of pressure. Well, were you wrong about a recession? Yeah, technically, yeah, you were. But I wasn't wrong about where we were headed. The direction of the banking system was in meltdown mode in March. Well, let's just not forget the bank term funding program, which now is about $160 billion last time I checked. $160 billion of distressed assets are piling up on the bank term funding program, which ends on March 11th. This particular program printed $400 billion. The program, the Fed, because of this program, printed $400 billion in 2 weeks to bail out the entire regional banking system in the United States. That is why we didn't have a recession. And so obviously I didn't know that the Fed was going to do that. They did it, and I changed my strategy and my opinion about the problems we would face in 23. But that's what they did. Now that program's going away, and I just explained to you how bad it's going to be for banks, because let's just say we have, for example, there's $1.5 trillion of commercial real estate loans that are going to come due in the next 2 years. These loans are 40% underwater now. So you can't tell me. You can make an argument that, Michael, well, it's not going to be 2008. But don't tell me that there's not going to be any stress in the banking system, and that these regional banks, which are responsible for 30% of all of their assets, 30% of all assets, their commercial mortgage-backed securities and mortgage-backed securities, 30%, they're not going to be able to make any loans anywhere near the extent that they have been in the past. And we have a debt-based fiat currency system. And when you make a loan, you create more money. That's how you create money. And when you create money to make a loan for the purchase of capital goods, that's how you grow. You grow the economy that way. It's the productive side of the economy. That's going to be completely impaired It's already impaired. It's going to get a lot more so come March and April.
Now, in the continuation of the episode, Michael Pento does a deep dive into the real estate sector. If you like the video, hit the subscribe button and check our pinned comment for some massive sign-up bonuses if you're thinking about adding crypto to your commodities portfolio. Now, let's get back with Pento and his forecast on the real estate sector.
First of all, you have to understand that the home price to income ratio is at an all-time record high. It's about 5.5 times. So the median home price is about 5.5 times more than the median family income. That the previous peak in the global financial crisis, right before that, was 5. So we're at an all-time record high. And buying a home now is 50% more expensive than just being a renter. And prior to the global financial crisis, it was 33% more expensive. Okay, so we have a situation where you have 20 to 25% of all homeowners are investors. That's just tremendous amount of supply that can come on the market. Once I see the labor market crack, I think the whole facade of a housing, a stable housing market crumbles. You see a lot of supply coming on the market when that occurs. And it all points to one thing. Are we headed to 2008? Another 2008? I think it's highly likely. What does the Fed do in response to that? Do they just simply lower interest rates back to zero? Maybe. Do they go back into QE? Maybe. Do they launch another, TARP, TALF, helicopter version of helicopter money? Maybe, but here's the big difference. Every other time in history, since 1987, that the Fed went down that road, they did it many times. They did it in the Thai baht collapse, Russia collapse, 2000 Nasdaq collapse, 2008, 2019 repo crisis, 2020 COVID. I mean, they've done it over and over again. Every time they've done it, there was a condition of deflation. They were fighting deflation. And deflation, by the way, done again, is a healing process. It is. So recessions and deflation are a way to heal the economy from the excesses. It's creative destruction, sort of, in a way, a version of it. From Joseph Trumpeter talked about it, famous economist. So the next time the Fed does this, the next time the Fed goes back into QE mode and ZERP and QE and helicopter money, I have a very salient fear and belief that relief that usually comes from lower interest rates. I mean, the Fed controls the short end of the yield curve. That there's no doubt about that. So they can always take interest rates to zero. T-bills will go to zero. Fed funds rate will go to zero. But the long end of the bond market, which is concerned about supply and inflation, might not respond favorably. In other words, prices could go down and yields could go up because you're not fooling anybody anymore. The value of a currency is the faith in a fiat currency is what inflation's all about. And people lost their faith in the U.S. dollar's purchasing power, not against the euro, not against the yen or the pound or the yen. They lost faith in purchasing power against hard assets, against edifices. So that happens again. The Fed goes down that same path. I think any relief that is normally found from lower interest rates, which is part of the deflation story, which is part of the debt default and reconciliation story, goes away because you could get rising long-term bond yields. And so there's no quick salve. if that's the case. So that's my caveat, and I'm watching it carefully.
What do you think of today's show? Is a major banking crisis going to happen in the next 6 months? Post in the comments section down below your forecast on the banking industry. And if you're having concerns about the impending U.S. financial crisis, thanks for watching the video to the end. Consider subscribing to the channel if you have not yet done so. And if you liked this video, check this one because you'll love it. I see you on the other side.